Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over the market conditions and ratios for a commodity bull market. Why do I say commodity bull market? Because that's where we are at in the expansionary phase of real estate, and we can see how these things are changing. We can also know that we're in a commodity bull market given where all these ratios are trending. So we'll look at these ratios, we'll look at the data, we'll see how they're performing. And again, nothing goes in a straight line. Things cycle back and forth. So don't think that if I say something like commodities are going to outperform the S&P 500, that there could be times, that could be months at a time, where they underperform, and then you get the next leg higher. So markets, they move in impulse moves up, they consolidate, impulse move up, consolidate. And conversely, if the other markets either go sideways or pull back, what I'm saying is the overall general stock market, S&P 500, NASDAQ, those types of companies with an increasing interest rate environment is going to go into a long consolidation period. So you're going to see them go down, and they'll go back up too. There'll be a bounce, and they'll consolidate in a big, large pattern sideways, just like commodities have done for the past 10, 12 years. So we'll look at the data. I'll show you what I'm seeing. I'll give you my financial opinion. So what I've got behind me, and this is the dollar. Usually in an expansionary phase of real estate, you get increasing interest rates throughout this area, usually towards the beginning, middle of an expansion phase of real estate. Then the dollar starts to decline in that environment. Now, the question is the dollar going to decline in this environment? I think so, but no one absolutely knows for sure. And usually when it usually declines when interest rates start to go up and towards the middle side of the expansion phase of real estate. And we are right at the beginning of this expansion phase of real estate, so it may take a little bit of time. Why is this a big deal? Because when the dollar goes down, the commodities, precious metals, at least if you're in America, are priced in that currency. So the denominator, if it's falling in value, will be a tailwind for commodities and precious metals investments. And right now we're doing kind of a retest type move. We've broken to the downside, and it looks like we're coming back up to almost do a retest to move on lower at some point. I don't know if we're there at that point yet. Looking at the 10-year yield, this is also what I consider to be market conditions. The 10-year yield's breaking out of its downtrend line. You can see two nice big yield months going up. So we've got 2 months going up for yields. We are breaking this long-term downtrend all the way back till the peak of the 1980, 81, and we've been declining ever since, and we're breaking that to the upside. This could have profound effects in the market if interest rates were to start a run like they had done in the 60s, 70s, and peak in 80s. It even started in the 40s and 50s. It started in the 40s, went through 40, 50, 60, 70s, and peaked in the beginning of 80s. Then we've been in this huge decline in interest rates. This is a paradigm game changer. Most people, what they know is a declining interest rate environment. They're going to say, go buy stocks, go buy bonds. Bonds and stocks work in a declining interest rate environment, just like the one we've come from. If we go into an interest rate environment where we are increasing, bonds and stocks do not do as well. That's a headwind. And commodities are going to do quite well, given where their valuations are, and we can go through all this. This is commodities here, priced in dollars. What this is a consolidation period here. We'll put it in logarithmic. There's logarithmic. Consolidation period, and then a break to the upside. Now, this isn't going to just go straight higher, guys. We are going to get a pullback at some point. People are going to be scared out. Think of it like this. Think of it like 99. We get a nice big surge. We get a little bit of a pullback. People are going to sell this pullback. It's the wrong move. You should be buying this pullback if you got the wherewithal. You've got the training, you've got Finding Value Finance channel. showing you the data, this pullback should be a buy. We should be holding this. You don't know how big this pullback will necessarily be. It looks quite obvious that if you could sell here and buy here, it'd be, it'd be awesome. You'd be really killing it. Problem is, we don't know what the pullback, when exactly it's going to occur, and how large it's going to occur. But if you would hold down, bought the dip, and just continue to hold, selling at this top in 2008 when the ratio was expensive, when real estate home starts went down in 2007, this is the blow off top. This is the top that you got to be trying to look and sell. Could you get this ultimate top? I don't know. I'd probably be inclined to sell even around here. Somewhere in this entire vicinity would be a good exit point. Here's the consolidation period. This is the period that I think will consolidate in stocks. And I can show you why I think that. And then we've got the break to the upside for commodities. It's breaking the consolidation pattern and moving on up. It will be trending higher. Doesn't mean that we're going straight higher. We will have pullbacks at some point. You're going to have to be mentally prepared for the pullbacks. And if we get some, I would use them as buying opportunities. So looking and going into the ratios, scrolling on down here, moving on down. So we're getting to, there's the ratios here. So the CRB to S&P 500. We've got this downtrend line. We've broken that. We had a nice little basing period. Big, strong buying pressure, small selling pressure. I know it's a ratio. Large up moves in the ratio, small drawdown or pullbacks. We do have a wick at the top of this one. Could we pull back a little bit? Yeah, we could. We could pull back. We could do a little bit of a sideways consolidation pattern before moving higher. The S&P 500 and the NASDAQ have taken off, so we got a little bit of a pullback in the ratio, which is absolutely fine and as expected. So that one's pulling back a little bit for the past 2 days. The platinum to gold ratio has been chopping sideways. We've been just moving sideways in this large ratio, which has been in a falling wedge pattern. It's broken to the upside. We've got the return move, and now I'm looking for a move higher out of platinum. And hopefully we get that move higher. We are buying at historically low valuations for platinum. The platinum to palladium ratio, platinum did make a little bit of progress at the end of the week against palladium, but we're very low. We're at 0.44, 0.45, somewhere in that range. And it's incredibly cheap for platinum. I do think that eventually platinum will outperform palladium, as platinum will substitute palladium. And usually platinum is about 2 to 3 times more expensive than palladium. A very expensive platinum to palladium ratio is 5.5 or anything over 5. We're at 0.45. Large valuation could be large valuation or large purchasing power gains could be had with buying platinum down here. Looking at the platinum to silver ratio, it broke out, kind of doing this retest moving sideways. That's what we've got for platinum to silver. So platinum is cheap in relationship to silver. People that say silver is the cheapest metal on Earth, it's not. Platinum is. Platinum is the cheapest on a historical basis for ratios. This is the gold to silver ratio. We've been trending higher, which means gold's been outperforming silver. Usually in a commodity bull market, we're going to see silver outperform gold. So I'm looking for that ratio to drop. We've been in this kind of upward uptrend, and I'd like to see this thing drop here at any point. See silver outperforming. Palladium versus silver. Usually in this type of environment, we see silver outperform palladium. We should see this drop to a very low level. We've had levels all the way down at 14, 15. That's where I suspect this to go over time. Dow Jones Industrial Average to gold. We've had this ratio really start to compress down. we're probably going to see a return move, probably back up to about 18 and a half, I should say. We're at 18, maybe 18 and a half, and then it peters out and comes back down, and gold starts to kick the Dow Jones Industrial Average's butt again. Big long-term perspective, we got this megaphone type pattern. It's been going back and forth between overvalued Dow, undervalued Dow. So overvalued Dow, undervalued Dow. Overvalued Dow, it'll go all the way back down here, which means gold's going to outperform the Dow Jones Industrial Average, is my guess. We've got the market conditions for gold to do well and for stocks to do not as well. So we have that ratio, and I think that's going to compress lower. The gold to oil ratio, that's where we are here. We're right at 20. This is a still cheap ratio. It's kind of getting, average is about 15. We're still slightly cheap. And I'm expecting this ratio to break where we're at. We're basically consolidating right on this resistance line and ready to break to the downside, which means oil is going to outperform gold. Oil should do incredibly well. It should do things that people aren't going to believe in terms of prices. That's my opinion. So I'm looking for this thing to break to the downside. We'll continue to monitor it. What does that mean if it breaks to the downside? We could see a big run out of it. That's what it means, and I think it's coming. You look at the inventory numbers, you match up the fundamentals and the market conditions, and oil looks like it wants to moonshot in 2022, which is this year. Probably summer, spring, summer, it's going to be moving. So I'm ready for it. And then I've got the copper to gold ratio. This thing's been just tracking sideways between this lower support line and this upper line. It's been bouncing back and forth. And that's what we've done so far with the copper to gold ratio. I do think that copper will outperform during some portion of this bull market. It did it last time. It consolidated here, broke to the upside for a little bit, and then came back. It's probably going to do the same thing. And it's going to do it kind of in the beginning to middle of the bull market, because that's when gold kind of lags a little bit and the commodities really take off. Looking at the S&P 500, just to kind of touch on it. This is the dailies. It's coming back up. We've had a nice, good pullback here coming out of this rising wedge. And then I think we're going to come back up and roll back over again. What's that going to look like? We'll find out. Remember, I'm good at looking at how these things are changing. The path is not known because it's short term. You've got wars going on, news all over the place, volatility, fear. There's all sorts of things in the markets that can move this up and down quite easily. But to me, this is something I would not be looking to invest in on the long side. And the NASDAQ is the same way. We've got this big wedge that built up and has broken to the downside. Coming on down, looking at some of the other commodities like lumber. Lumber's been chopping sideways here at a pretty elevated price. So that's expensive. Nickel's been at a very elevated price. This could move all around, but it's broken to the upside, its pattern. Palladium, I expect this to actually head lower after the war is done and all the hype around it. But I do think this will head lower. This is kind of our metal that does opposite of everything else. It does have shortages and market deficits. So this could remain elevated, but platinum, I think, will eventually start to be substituted out for palladium. Or palladium will be substituted out for platinum, sorry. And platinum will eventually work its way higher. Cocoa futures are down a little bit this past week. But overall, guys, this has a big pattern that's consolidating upward. Higher lows and the highs all the way back to 1980 will be broken at some point, and probably a large move. Wheat's been moving higher. It's had a pretty big move already. You might have a little bit of a cool-off period. You can see that we've got a reversal day. 3 large up days and then a reversal day last trading session. Looking at soybeans, we've got this break. We've basically doing a back test right now. This thing's up in no man's land. So we had a breakout. We're coming back and doing a retest. It might take it may consolidate for a little bit before going higher, but that's probably going to head higher. Corn futures. This one's also making a run for the border. There's the border up there. It's making a run. Yeah, we had a down day yesterday. We've had a pretty good run up here. We might consolidate below this before taking another run at it. Copper priced in dollars, just moving sideways at a very high level. It looks like it's about $4.50. We've got the global price index of all commodities through the roof at basically all-time highs. It could pause here for a little bit and then break through it, leading to a breakout. The producer price index has been rolling higher. This thing's been on a tear. This is what it looks like, and you can tell that this thing is way up there. Looking at housing starts, is at 1.638 million. It was a little bit lower than the 1.7. We are still above 1.5. We are still in an uptrend cycle. Housing starts is the driver of where all this inflation's coming from, in my opinion. Whenever we go into an expansionary phase, where this yellow line here, whenever the blue line goes above it quite substantially, we're in an expansionary phase of real estate. If certain market conditions align with this expansionary phase, we get a commodity boom. Commodity boom here, and then a commodity boom here. This is an inflationary environment during these areas. The M2 money supply goes up. Yes, the M2 money supply contribution from housing starts could be lower with all the stimulus money that they're throwing into the system. So this may have less of an impact in terms of its total control, but it still means that the market conditions are there for a large move in commodities. And I still think it's the leading factor because this is the money that actually gets into the system. It's the money that hits the hands of people. And when this goes down and it crashes, you get a deflationary bust. So that's where we're at in the overall total market cycle, guys. That's what I'm looking at. That's your market conditions. Everything remains robust. We could have pullbacks at any point in some of this stuff. I see it as buying opportunities with the pullbacks, depending on what it is. We may not see a pullback. We might. The short term is the least reliable when looking at technical analysis. And I'll do another clip on all that stuff and how I kind of came up with kind of the thesis for everybody. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.